What's going on, everybody? Welcome back to the channel. Hope you guys are having a good trading day. If you're not taking trades, make sure you're back testing. But this video, we're going to do something a little different. We're going to go over like a learning session almost, go more in depth on candlestick anatomy, actually find out what a break of structure is, a liquidity sweep, which is pretty much all I use to take my setups anyways. So with that being said, we're going to jump right into the easiest one, which is candlestick anatomy. You have obviously a green candlestick, and then you have a red candlestick. Green is up, red is down. But each candlestick has a high, it has a low, it has an open, it has a close. And so for a green candle, the open is always going to be on the bottom, because if it's green, the price has to be higher than when it opens. So open is always going to be on the bottom, and then the close is always going to be on the top. And then each candles will have wicks. Mind my drawing. But each candle gets a high and a low wick. So at one point, price pushed up to here, and it made this high. And then at one point, price pushed down here and made this a low. And so when price pushed down and made that low, since it was below the open, it would have been red here. So this is when it was a red candle. Buyers came back in, pushed it up. It was at a high of here at one point, and then it closed. And then it's pretty much the same thing for a red candle, except the open is going to be on the top, and the close is going to be on the bottom. And obviously the highs and lows will still remain the same. There we go. This at one point was its high, and then again down here at one point this is as low as it pushed. But buyers came back in and at least pushed it to its closing point here. So with that being said, you have a green candle, like I said, which is a move up, like this, and then a red candle, which is your move down. So anytime you have a consecutive green candle, then a red candle, so a move up and a move down, that create a high. And the higher time frame it does that, the better. Oh, not high. There we go. So you have a move up and a move down, that creates a high. But if you have a red candle, then a green candle, so a move down and a move up, that's going to make a low. Oh, there we go. It's going to make your low. Okay. So now you know a red candle, then a green candle makes your low, and then you know a green candle and a red candle makes your high. So if we go down and look at the charts, we can put this right into use. Right here. You have this move up and a move down. You take the highest wick. So I don't take the closes. I take the point where it wicked highest, which is right there. That would be your high. So you have a move up, move down, highest point between the two, that's your high. The reason why this isn't a high, you have a move up and a move down, you could take the red wick all the way up here, but when we're watching this live and I see that this opens here and then pushes all the way back up, I'm not really getting a retrace within this high back down. So this is a prominent high because we retraced back down in it, and then you have a move down and a move up and a strong wick back up, but you still take the lowest point. So this would be your low. So you have your high and your low. You don't want to take like consecutive green candles, like move up, move up, move up. This wick up here, I'm not counting that as the high because there's no move down after it. This up here would be your high because we've retraced back down within it. And then same thing for the low right here. And speaking of highs and lows, we're going to now focus on trends in the market, so the types of markets, pretty much. And so this is a perfect example right here of an uptrend. You have a low, you have a high, you have a lower low, you have a higher high, you have a lower low, you have a higher high, so on and so forth. So this is clearly an uptrend. Anything that makes higher highs and higher lows, so moves up, move down, move up, move down, move up, move down consistently, that would be known as your uptrend. And then you have obviously a downtrend, which is the opposite of that. So perfect example is right here. You have your high, then your low, and then you have a lower high. Then you can count this as the lower low. Then you have your lower high. Then you have your lower low, so on and so forth. Your downtrend. Then another perfect example is consolidation, which is the last type of markets. There's only three. There's uptrends, downtrends, and consolidation. Anything else, if it's doing wonky stuff, you don't just don't pay attention to it. But a consolidating trend is where you have relative equal high and relative equal lows pretty much consistently after each other. This isn't a lot of consolidation here, but it works with what we're saying. So this, I wouldn't be looking to trade anything in because it's you have relative equal low here's, but you don't have relative equal highs. So like this is a choppy market. Could it go up and take these highs? I don't know. Could it come back down and take out these relative equal lows that it made? I don't know. Clearly it did, but I don't want to be betting that live, you know what I mean? Because there's too much liquidity bouncing here, 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 here. So they could go either side. It just depends where the market makers want to take it. So, I'm going to come back over here. You got your candlestick anatomy. You got highs and lows. Now you got types of markets. You got an uptrend. We're going to draw this out. You guys might want to get a journal and write some of this down. There we go. And you have a downtrend. And lastly, consolidation. There we go. We'll just put consolidating. So when it is consolidating, I'm not looking for any trades. When it's in a downtrend, obviously you don't want to trade against the trend on these moves. On these move ups, you want to be looking for the best entry down. Same with an uptrend. Anytime you're looking at these moves down, you want to be looking for the best entry to the upside. And so that means you pretty much got to be buying where other people are selling. Retail traders are going to come in, they're going to see, oh my God, market is moving down, we're no longer in an uptrend, sell, 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 sell. No, in reality, a lot of stop losses get put here. Once this area gets hit, it's going to reflect up and push higher. And anybody who was selling, put their stop here. So as it pushes above this point, it took their liquidity, it took their sell stops, and it just kept pushing higher, and so on and so forth. So you pretty much want to trade against what the retail traders are doing. They're selling on this move down. You want to be buying on this move down, aiming for higher areas of liquidity. Okay, now that you kind of got the basics of candlestick anatomy and the basics of the types of markets, we're going to move straight into liquidity because this one is very important, and a lot of people don't pay attention to it, and they use it the wrong way. So the way I use it is liquidity sweeps. I'm looking for reversals on the highs and lows, which is pretty much where liquidity lies. So we can draw it out real quick. So let's say we're in an uptrend. Boom. Right where this liquidity is where it's going to lie. Liquidity lies above the highs and the lows in a market. So if we're in a downtrend, the liquidity is going to be at the lows. I'll just put LQ for short. And the reason that is because, like I said earlier, when retail traders are selling on these moves down, they're putting their stop losses on these highs. So when price eventually pushes above these highs, it takes them out of the market. They now have to buy back their position at a higher price, therefore turning it into liquidity for the market makers or for whoever is pushing price higher. So these sellers get knocked out. That then turns into buy side liquidity to then push it further. Same thing with this downtrend. Any person buying on these move up, their stop loss is going to be set at the bottom. Price pushes lower, knocks them out of the trade. They had to sell back their position, and now it's sell side liquidity, and it's just pushing further down. So this example on the charts is perfect. I have one lined out, this red line here. We'll go to the 15-minute time frame. And if you see, this was a prominent low in the market at one point. Had a strong V-shaped recovery, big rejection up. Like we saw big moves up after it hit this point. So that was the key level for me that I had marked out. When we come over here, when it finally pushed just a little bit under that level, you can see it even closed, but it wicked and then just big strong rejection again. So when that happens, when it's around that level that I had marked out, this is exactly what I'm looking for. And we can jump right into a fair value gap, which is what I want to talk about next. So this red line is our liquidity zone. And what do we see going in and out of it? Two fair value gaps. You have one here, which is sell side, and then you have another one coming right out, which is buy side. Okay, so when I see two fair value gaps like that in a liquidity zone, this is a perfect setup. And let's just talk about the basics of what a fair value gap is in general, or some people call it a price imbalance. All it is an imbalance in price action. Okay, so what that means is when you have these gaps, it wicks down and then price opens here and then it pushes down and then it makes a third candle and it wicks up, but it leaves this gap, no connection in between this wick and this wick. So there's a gap here. That means there's a lack of buyers. So when price pushes back into this zone, it was able to fill sell orders so easily. That's why it creates this imbalance. When price pushes back to this zone, since there was a lack of buyers, technically what you're looking for is it to hit there and reject to move further so they can fill their sell orders more easily because there was a lack of buyers. So a fair value gap is a 3 candlestick pattern that stands for an imbalance in price action. And price is always going to want to balance out that price action more often than not. That doesn't mean when you see a fair value gap breakout, you're like, oh my God, bullish fair value gap, I'm in there. No, that's not how that works. You don't want to take that much risk because there's times where it can be a breakout gap like this. So a breakout gap is when you have a fair value gap that formed, but it never got retested. So as you can see, we had a fair value gap coming into this liquidity, wicked up, breakout gap coming right out. That is a strong form of a liquidity sweep because you have a V-shaped recovery, and when it makes that breakout gap, that means the market is reversing strongly. It needs to push price higher. It doesn't want to consolidate. So as soon as you see that, you start looking for some buy orders. And with that being said, that is pretty much all I wanted to go over. We're going to jump right into the trade recap I took today as this plays out live. So when I saw this liquidity sweep, I knew that this was the breakout gap. Ideally, I was looking for this to be filled, and as you'll notice, there's an inverse fair value gap. You have a 5-minute gap here and a 5-minute gap out. This one now became inversed. A lot of the times when I have an inverse gap, I like to retest that zone, but we push higher than these highs, so now I know buyers are coming back in the situation because we disrespected these relative equal highs here and here. We pushed higher, came a little lower, just missed this gap. I had an entry here, but it didn't fill it, so I didn't get to enter. And then again, if you have no entry, don't trade. You guys need to be okay with missing out. The fear of missing out was a hard thing for me to overcome. I always wanted to be like, damn, I really missed that trade, and I would beat myself up for it. But you guys got to be patient. Your time will come. Your entry will happen. Trust me. So once I see we made this high, we retraced in it. Made this low, we retraced in it. Had this tiny fair value gap. Had my entry right at the top wick, and look what happens. It wicked slightly in, and where does it go? It's a bull run. So I actually did take this trade today, and I have the proof. I'll show you guys on the charts here in a second. But we're gonna go ahead and put the entry here. I set my stop loss at this low. Oh, there we go. Nope, come on. There we go. Okay, I have my stop loss at this low. And since, obviously, we're in a long, I'm going to be looking for opposing sides of liquidity. So my first take profit zone would have been around here. Ideally, since I entered back down here, you could take some out around here, which I believe so I did. I was aiming for the top of that here. But ideally, this gap where there's no wick to even the close price of this wick, that is where I was aiming. So let me show you guys the actual profit zones I took on this trade and why I took it in the first place. And I don't fake my trades. Yes, I lose sometimes. I'm not perfect. It's a live account, as you can see. So this is real money. Right here, bought 0.03 lots, right where I got wicked in. Again, I took out first take profit levels when it came above these highs here. Second take profit levels when it came above this high. And then at this point, I like to trail my stop loss. So, like I told you guys earlier, any move down and a move up creates a low. A lot of the times when we're in uptrends, I like to put my stop loss right below lows. So that way let's say I forget, I pay attention, something happens, market is unforgiving sometimes and it just spikes down out of nowhere. I like to be able to save my trade as much as I can. So after this entry, I started putting my stop loss here because this is the low here, and then I eventually did it here, and then I eventually did it when we were live here. And so I have my stop loss right below that low right there. Make this white so it's easier to see. Okay. So once price pushed right below here, I got wicked out. Either way, this was still a decent trade. Was let's see what that was, 1 to 3, I think. Yeah, 1 to 3, pretty much 1 to 3 risk to reward ratio trade. Depending on what you risk, that can be a good amount of money right there. Not gonna disclose how much I made, but you know, you guys will find your groove. You'll find your passion in doing this. I'm still learning, so I'm just showing you guys my journey, showing you guys how I take my trades. But yeah, that is it for the video. A little trade session recap, a little learning session. Let me know if you guys want me to go over anything else. I can go over ICT strategies, TJR strategies. I can go more in depth on the fair value gaps if you guys have questions, more in depth on liquidity sweeps, more in depth of the time frames I actually trade. You know, just subscribe, comment, and let me know. But yeah, hope you guys stay safe, stay locked in, and stay profitable.